Good afternoon, everybody. Welcome to the Fiscal Philosophy YouTube channel. We are firmly in correction territory, and I, for one, have been collecting my thoughts and making some tweaks and reevaluations on some of my processes in order to try to ensure that I take advantage of this opportunity. Anytime the market turns red, it does open up potential opportunities. Now, I'm not one to sit here and say that a 5 or 8, 10% correction in the stock market is a quote unquote generational buying opportunity. However, not all companies respond to these downturns equally. Some fall harder than others, some more unjustifiably than others, some deservedly so. And the real opportunity is in identifying those asymmetric opportunities, which ones have been affected the most and the most unjustifiably. So that also brings me to what kind of things I'm going to be favoring during this correction, because I don't think I should pause all investing activity, because you never know when the correction or whatnot, the downturn, bear market, whatever you want to call it, you never know exactly when it's going to end and when it's going to start to turn around. And some companies may hit their respective bottom sooner than others and begin their recovery earlier than others, while some may never actually fully recover. So a couple of the elements I'm looking at are fundamentals that keep growing, valuation that is relatively low compared to that growth, as well as direct return of capital to shareholders through especially buybacks. A company with a robust buyback program can make bank for shareholders during these kind of market corrections, right? Because suddenly they're buying back shares at like an 18 or 20x multiple in the case of Alphabet here, instead of a 25 or 27 times multiple like they might normally be. That is so much better and more shareholder friendly that you'll be wishing that they stayed this cheap for longer at the end of it. That's if you're a shareholder. Now, obviously, Google is kind of the low-hanging fruit. I also think that the bear case is sort of the narrative following the stock price. Once the stock started falling, the FUD on like Twitter and such is, oh, the LLMs are gonna come for their firstborn. They're gonna just smoke them, and it's gonna be bad, etc. But then when you think about all the bear cases you see from retail investors throughout the whole market, a lot of it doesn't really add up when you put it all together, right? Because there's also a bear case against Uber that has to do with, again, Waymo, which is owned by Alphabet here, coming to take their lunch. And it's like, well, if Waymo is going to be great, shouldn't that be bullish for Alphabet? Well, no, because LLMs are going to come for Alphabet, but Alphabet is in that like AI space as well, and also they're actually in that quantum space, which is still very highly speculative. But if your bear case for tech has to do with self-driving, with AI, with anything like that, Google is positioned relatively well in those spaces. Plus, they have their growing cloud business. They have YouTube. They are still the goat of search. They have Chrome. They've got Maps. They're so integrated into our everyday lives. I think people are kind of blowing out of proportion the effect LLMs are going to have on Google's bottom line. That's just my take. I could be wrong, but I do think this is a pretty low-hanging fruit, pretty attractive opportunity. Is it pound the table good? Maybe not. Like, maybe there is something out there that is a better value, but certainly as far as businesses that are household names with wide moats in the Magnificent Seven, that so-called Magnificent Seven, this is probably the most undervalued in that area at the moment, at least for like traditional valuation metrics. So if you want one of the slightly less obvious things I'm in that maybe isn't quite as popular on Twitter, and this is close to the price I bought it at. I was in very close to $75. It's not really moved much since then, and it just bounces between maybe 75 and 80 as of recently. But this is one I actually got before this big correction started. It's a Swedish online wagering company called Evolution Gaming. A lot of the major players in that industry, the casino industry, etc., use their platforms and their software. They have what I would consider to be a pretty good moat around their business, and their margins are ridiculously good. Their revenue is growing, and they trade at less than 13 times their own earnings. They have a fairly robust 3% dividend yield, and the last 6 or 7 quarters, they have been implementing buybacks. And I think the expectation is that, of course, that they continue or even potentially increase those buybacks substantially. Now, the only real drawback here is that this is only on the OTC markets in the US, so not every brokerage can you buy this. I don't think you could buy it on Robinhood, for example. But this could be a real compounder. And also, the whole tariffs issue, since they don't export any physical goods to the US, and their software is used pretty much like everywhere, like Asia, Europe, the US, etc. There's really not a big threat to them in a direct way. Now, if the global economy takes a dump and people don't have as much money to basically gamble away, then yeah, okay, that could be a case against them. However, it's interesting that when you look at the way people act during times of stress, the vices don't get hit as hard as you would think. Like, cigarette companies still do fine. Speaking of which, that might cover one of those in this video, since I hold one. People may drink more. The cannabis stocks out there, maybe people will, light up the ganj a little bit more. So I don't worry that much. Vices, I don't think, are going away. And even if there's a big problem in the global economy, recessions tend to be temporary in the long run. So I wouldn't be too fearful on this. And again, their direct exposure to a lot of the possible turbulence happening in the near term should be relatively limited. But, everything is so interconnected that nothing, I think, fully escapes a global recession. Okay, so I already alluded to this, but I'm also obviously hanging on tight to my shares of British American Tobacco. In my value account, this is my third largest holding at the present moment. And while names like Amazon and Uber and so forth get obliterated, this thing is like a rock, okay? It has a relatively cheap price to free cash flow in the single digits. Same with their forward PE. They also pay out a very robust dividend and have room potentially to do a lot of buybacks. And there is pressure on management to focus more on buybacks because, again, even in the low 40s, the valuation is still relatively cheap. I accumulated most of my shares in the 30s, so I'm doing well both price-wise and on the dividend that I've collected and continued to collect. So I'm winning from all angles on this one. I'm not 10xing or anything, but it's a good, solid, very cash-generating business. It's addictive, and they sell their products all around the world. Now, they're a British company, and this is another angle that I haven't fully looked into, but since the UK is not part of the EU anymore, and there's a bit of like a back and forth right now between the US and EU on tariffs, it may not actually negatively affect BTI if the UK stays out of that fray and isn't lumped in with the EU, which I think they wouldn't be. So they might end up coming out of this pretty well. So I like having them as a big core holding of mine for those reasons. And even in a bull market where they may underperform a little bit, they're not gonna again 10x. They're not gonna be like a Palantir and go from $6 to $100 or something, but they can be as steady as she goes, quote unquote quality compounder, and that is good enough for me. And during these times, I'm certainly glad I've got something like BTI doing its job in this portfolio. Now, this next thing might surprise some of you, but I recently bought puts on ARK Innovation ETF. That's Cathie Wood's ETF, or Crashy Wood, as we like to call her. I only did this a few days ago, so I have not benefited from this full month of cratering. However, you can see where it looks like things might be headed on this. Now, if Tesla continues to get punished, Palantir continues to get punished, Amazon, which I am long, actually, if that continues to get punished, these are all things held in ARK. And, you know, I might as well, if I'm going to take some punishment in some of my stocks, even ones I like, temporarily on the one hand, I may as well benefit from the collapse of an ETF that holds maybe a couple names that I like, but mostly ones that I don't on the other, because they're sort of leading this charge on this correction, right? Who's getting hit harder at the moment recently than Tesla and Palantir, etc.? I think that innovation without cash flow to back it up is probably not going to be the thing that's most in favor right now when people are panicking, because at the end of the day, they sit there and to them, to most people, stocks are just a number on a chart that goes up and down. And if they're lacking confidence in the business underneath, or don't even understand the business underneath, they're more prone to just sell when things look a little bit tough. And I think that is the case for a lot of people when it comes to those high volatility, high flying names that ARK loves to buy so much. So this is one of those things it's a very small position. It was just a couple of puts. It's a little bit of a frisky thing for me. It's the first time I think I've ever really been directly in a position that is short something. So I'm dipping my toe in. That's how I would describe it. However, since it's through options, that position, if this trend continues, could multiply in value multiple times, which could be a net handful of percents of gain in my portfolio to offset some of the pain I'm receiving from this bear market, as everyone who is mostly long right now, various companies, is probably hurting at least a little bit at the moment. So this is it's kind of a frisky play. I'm not necessarily recommending that anybody do this, especially if you're not comfortable with it, don't understand it. It's not your style. Dollar cost averaging is always an acceptable approach. This is just something that I did so that I would have something that's green during this time period. Make sure to comment below and let me know what your approach is during this interesting and fascinating correction. Also, my Discord is linked in the description. We're having a good time in there talking about what's happening and who's getting clobbered the worst. Make sure also that you consider subscribing to help me grow the channel, and catch me every Saturday, 8 p.m. Eastern, Cashflow Kings Live. Also, my X account at Mr. Macho Mog. Could always use a follow there to help just build up my clout on the internet, so to speak. Ladies and gentlemen, have a wonderful day. Take it easy.